today we're kind of talking about the big, beautiful bill that came out and a part of it. And for that, we have our CFP, Harrison Johnson, here with us. Harrison, thanks for being here. And today we're talking about what's the deal with these Trump accounts for kids, because we're talking a little bit during the break. Kind of crazy sounding.
So, yeah, these Trump accounts or MAGA accounts or whatever you want to call them. I'll start off and say, I'm not really a fan of this because of the way the account works. So to start it off, any child under the age of 18 can open one of these things. Not yet. You can open the accounts, I think, like July of next year. So you can't do anything yet. It'll all be about a year from now. But any child under the age of 18 can open one of these things. But children born 25 through 28, tax year 25 through 2028, can receive or will receive $1,000 in seed money from the Treasury. And there's no income limit to that on the parents. So $1,000 for the kids. On top of that, parents, friends, relatives can contribute up to a combined extra $5,000 a year to these accounts. And here's where I don't really agree with how these accounts are set up. The investment grows tax deferred, which is fine, can be invested in mutual funds and ETFs and things like that. However, the seed money, so that $1,000, when that gets withdrawn, that's taxable at ordinary income rates. Any earnings that occur inside of the account are taxable at ordinary income rates. If parents or anybody contributes extra money, that's not taxable. But ultimately, this kind of functions like a non-deductible traditional IRA. So any money that's put into it, you don't get a deduction for putting money into it as parents. The money grows tax deferred, and then all of the earnings and that seed money is taxable at ordinary income rates. So there's a lot of other options that I think are a whole lot better, like even just a regular brokerage account that's subject to capital gains would potentially be better than this for extra contributions into it.
Now, not that the government would ever do this, but it sounds like they made it sound really good. Like, wow, you're going to get $1,000 if you have more kids, is what they're kind of trying to do here, I think. But when you look at the numbers like you just did, it's really not that great of a deal.
The $1,000 is a good deal, I guess. I mean, $1,000 is $1,000, so that's great.
Great, yeah.
Yeah, it's technically a taxable $1,000.
Right.
You're not paying taxes on it now, but when it's withdrawn, it's taxable. So the $1,000 is the best part of it. But as far as the ability to contribute more money to it, I can't think of a situation where anybody should be contributing more money to this, because the account is just not an efficient, growth account.
I just don't understand. I mean, you already have 529 plans. I mean, this is worse than a 529 plan, because at 529, if you put the money in, again, you don't get a tax deduction for it here in California. It grows tax-free. And then if you use it for education expenses, well, that distribution is tax-free.
Yeah.
But if you don't use it for education expenses, then it's taxable at ordinary income. It's like, why didn't you put $1,000 in a 529 plan? We didn't have to create all new accounts. I don't know. I think it's
that would have been better. And with the 529 plans, now you can roll money from a 529 into a Roth IRA. I'm not sure if that can happen with these accounts. I was trying to figure that out, and there's probably going to be some guidance that comes out on what you can do with that money, whether it can be rolled over or converted into an actual retirement account. But right now, the way that it's written in the bill is this functions at age 18 as a type of retirement account, which means if you withdraw money before 59 and a half, so that means these kids will have 6 decades potentially of money growing in here. If you withdraw before age 59 and a half, there's a 10% penalty unless you use it for first-time home purchase or education costs. But even if you use it for those exemption purposes, it's still taxable. Withdrawals are still taxable.
And I really, again, as you said, I would not recommend anybody put money into this because now imagine you have basis in it because you're putting money into it over the next 18 years for your kid. Gosh, talk about complexity in 18 years from now. It's like, what's taxable, what's not taxable? If you move it into an IRA, well, how's that going to function? I think we've just created so many problems from these that just didn't need to take place.
And that money would be far better to put into a 529 plan or something else. Why would you?
529, Roth IRA, even like a brokerage account, because Chase and I were talking, since you invest in ETFs or mutual funds or whatever, it's not something that you're going to need to buy and sell. It's kind of like you can't access the money until age 18. So that means the money is going to be in there for 18 years and there's no way to get around that. So what's going to happen is people will put money into this, invest in something, hold that for 18 years, and then decide what they want to do it from it at that point, which means if you're not selling anything, you wouldn't have been realizing any capital gains if you had just put that into a regular brokerage account. The difference then is that brokerage account, when you sell it, would have a capital gain, subject to capital gain, lower taxes than this, which is going to be ordinary income. So the original plan that the House passed had ways to access the money where it would have been taxable at capital gain rates for certain things, but that didn't make it all the way into this final bill that was passed into law. So now it's like, it's really, there's not a case where this is better than anything else. A 529 would be better, a Roth IRA would be better, a custodial account would be better, a brokerage account for the parents, or really, if the parents want to help their kids, in many cases, they should be just adding money to their own retirement account so that their kids don't have to take care of them.
I can't wait to see, and hopefully it'll be around in 10, 15, 20 years. I think it's going to be such a nightmare, such a mess, and it just adds more complexity because now you got the 401k, you got the Roth, you got the IRA, you got the 529 plans. Now you got this little thing over
But
here.
I had the Cordurval savings accounts. Those aren't very popular. I know I've seen them from
Yeah, it's
time
like
to
an
time,
education
but
retirement account.
Yeah.
Yeah.
it's just overly complex, I think, for no reason. And I mean, Harrison and I were talking. The only thing we can think of is them adding this extra layer of taxation. Is like, well, they give you $1,000, but they guarantee themselves essentially of getting money back in tax
Taxes.
revenue.
So yeah.
But it's in 18 years.
Yeah, so it's funny because there's a cost to this, because if every child born between this calendar year and through 2028 receives it, the Treasury has to dole out that money, but then they're gonna get that back and taxes on the earnings. So I don't know what the actual cost of this is going to be, but again, any parents or family members, don't add money to this thing.
Yeah, I just got to make sure I have maybe two more kids within the next 3 years.
Yeah. I mean, the $1,000, you're right, is nice. It's $1,000, but it's just like it just kind of empty after that, I'll say.
Yeah, unfortunately, the intention was good. Again, the original House plan had capital gain taxes built into it, but now it's just like a non-qualified annuity or an IRA that you make after-tax contributions to that grows tax deferred, and nobody should ever contribute to those types of accounts unless you're doing like a backdoor Roth contribution or something.
Yeah. Not great news there, but again, that's what
You
we're
get
here for.
$1,000. It's taxable, but you get $1,000.
That's the bottom line.
Yeah.
So, and that's what I want to do is want to give you the true information, because you're going to hear a lot of stuff probably about this, this is great and so forth. You dig in the numbers.
Don't do it.
Yeah, don't do it.
Well, take the $1,000.
$1,000,
But that's
yeah.
it. Don't add to it. Don't do anything else. Do something else. Roth IRA, something else. So cool. Harrison, thank you very much. Great information.
Thanks, guys.
All right.